Good afternoon, everyone. In today's video, we're going to be doing a step-by-step walkthrough of the four major index markets that we have. We'll take a look at the S&P, the Nasdaq, the Dow, and the Russell futures markets, taking a look at where we had both trade opportunities setting up, along with places where we didn't have trade setting up. So in today's case, we had a trade opportunity in the Nasdaq, along with the Russell futures, both of which were some fairly nice winners. So we'll cover each of those. And then I'll also take a look at the charts of the S&P and the Dow to take a look to see why we didn't have any setups there. And I think along the way, this should help in terms of illustrating this whole idea of adapting to the volatility conditions that we're currently seeing, along with having a very specific set of triggers to try and get you into those trades. And in case you're new to the channel, we'll also talk about that first hour test, which is a pretty critical part in terms of gaining a bearing with the volatility for the day. I'll take a look at that on just the Nasdaq futures, which should be at least a good example. And then for the S&P, the Dow, and the Russell, we'll go through that a little bit quicker. So starting off here with the Nasdaq futures, with the first hour test for the four major index markets, we draw a line at 7 a.m. Pacific, and we're taking a look to see if price action has breached either side's cyan entry lines. That's our entry point on the volatility box on our scalper volatility model. Now, the scalper model is the most aggressive model that we really have in our toolkit, and it's the volatility model that we use to start off the day, especially in the indice futures where we have the scalper that's not in beta mode. So now with the Nasdaq futures here, you take a look, we'll see that price action didn't come close to breaching either side's cyan entry lines, right? Price action was really just chopping around sideways here inside of our box. And so that's our first sign that, hey, the scalper volatility box model is being respected. You can continue to use it. Now comes the next hour in which we had price action really start to tell us something different here. Right, so we had price action in the Nasdaq start to sell off. That sell-off really started right around that 7:30 time period. And then by 7:37 right here, we had already breached our volatility box entry lines on the scalper volatility model. Now, once we breach the scalper entry lines right here, we're then looking for an edge signal confirmation. That edge signal looks either like a green arrow right here in the case of long setups or a red arrow right here in the case of short setups. And this is nothing more than our version of an overbought oversold indicator. And that's really what is our second 1-2 punch duo to try and confirm that, hey, this volatility box model is being respected. Now, if say we do see that edge signal arrow right here, then that's where we're looking for an opportunity to enter at the cyan lines or better prior to us going outside of the clouds and then looking for the same move on the opposite side. That's our first target. And if we go outside of the clouds here prior to seeing the edge signal arrow, then we continue to adapt to volatility. Now, in terms of what adapting to volatility looks like here, we have the scalper. Then outside of the scalper model, we have our aggressive volatility box model. If we break that, we have our doomsday aggressive. If we break that, we have our conservative. And then finally, if we break that, we have our doomsday conservative. And this is really for scenarios like March of 2020. So now come back in here. We take a look at the Nasdaq futures. Once we saw a breach of our volatility box cyan entry lines, we continued to go outside of the clouds here. We didn't see an edge signal arrow in time, and that's what then takes us from our scalper to our aggressive volatility box model once we go outside of the clouds at 741. Now, once I load in the aggressive model here, we take a look again. So again, that 741 candle here breaches our cyan entry line. Once we breach that cyan entry line, we still have yet to try and find a model that's going to do a good job of containing this move in the Nasdaq. And so that's where off of the aggressive now, if we see a green edge signal arrow, that's to confirm that, hey, this model is being respected. And we see that before price action goes outside of our clouds right here, then we know that, hey, we can continue to participate in this model. The aggressive volatility model is doing a good job of containing price action, and we have enough of an edge here to try and target the same move on the opposite side. Now, to give you an idea of what that risk looked like on the Nasdaq futures, that's a bare minimum move of 45 points, and we typically give it a little bit more buffer room outside of the stop, just so that you're not stopped out for a wick or something like that. So typically right around $50 extra on the full size contract. So this is 45 points that we're looking for on the target side as well, which takes us to right around that 170 level on the Nasdaq futures. Now we keep coming forward here. I'll try and just step through this step by step in terms of candle. We're on a 1-minute chart. So keep going. So far, you're seeing that this level is being held. We haven't gone outside of the clouds here. The low here was 1286, but we are still inside of our volatility box clouds on the aggressive level. So we're still on the lookout for that 1-minute edge signal, but outside of that, the model is being respected. Keep going forward. Now we're starting to see the candles turn green. Keep going forward, and we finally get that edge signal arrow that we're looking for. Once we have this green arrow, the trade is a go as long as we have an opportunity to enter at the cyan lines or better. And then if that gets filled, we're looking for that same 45 points on the opposite side for our first target. And then our second target is at this gray target line on the opposite side with a break even stop on that second contract where this was right around 89, 90 points on the Nasdaq. Now we keep stepping forward here, and we did have an opportunity to enter at the cyan line. And then now if I zoom out here, you can take a look to see how perfect of an entry that was on the Nasdaq futures for today, right? So we really had as picture perfect of an opportunity to try and catch this reversal. We had our setup in terms of a breach. We got the edge signal confirmation, and then we even had an opportunity to enter at the cyan lines or better. We ended up hitting that first target pretty quickly, and then the stop was moved from outside of the clouds to break even. And then that second target was again at that gray target line on the opposite side, 89 to 90 points away based on if you rounded up in the Nasdaq futures, which we comfortably hit. Notice that that acted as a little bit of a magnet where price action chopped around sideways for a bit before finally deciding to go away from that zone. We come out, we take a look to see how much the Nasdaq really rallied from the point in which we had our entry. Just to close the day here, that was right around a 211 point rally from the actual point of entry. That's again best case scenario if you have a crystal ball, so I wouldn't call that anything that is something you would have foreseen. But this whole notion of participating, looking for our first target and our second target here, were valid plays on the Nasdaq. Now let's switch gears and move on to the Russell futures. Now that you have an idea of how this process works, we should be able to go through this a lot quicker. So again, starting off with the scalper and the Russell here, that first hour, we didn't breach either side's volatility box sign entry lines. That's our sign that, hey, we can continue to use the scalper. Now in the next hour here on the Russell, you'll notice the clouds went so far as to actually invert, which is a sign of how much volatility we were seeing in the marketplace in the Russell based off of what the scalper could handle. Now, that's why, again, this is the benefit of having multiple volatility models so that we can adapt whenever the market is doing something like this instead of being forced to try and figure out what we should be doing. Right, so here again, price action breaches our sign entry line once price action crosses the zone right here. Once we see that, we're looking for an edge signal confirmation. That does not come in time prior to us going outside of the clouds, so we continue to adapt. Now we move on to the aggressive volatility model. You'll see again the aggressive didn't do a good job of containing price action. We breached our cyan entry line, but we ended up going outside of the clouds prior to seeing that first edge signal confirmation. Now we switch over to the doomsday aggressive models. Same thing, right? So again, so far we've been able to, in the same move right down here, we've been able to know not to use the scalper, not to use the aggressive, not to use the doomsday aggressive. That leaves us with two different opportunities in which we have volatility that can be contained. Now we switch over to the conservative volatility box, and you should notice the conservative, again, does a much better job of containing price action here. We breach our cyan entry line. Once we breach, we're looking for an edge signal confirmation prior to going outside of the clouds. The conservative was the first model that actually did that. We got the edge signal right here. Once that happens, the trade is a go. We're looking for an entry at the cyan line or better, which we got filled in this retest right here of the wick. And once that happened, the trade was really just self-managing. The first target that we were looking for on the Russell was a fairly nominal target off of the conservative box, bare minimum move of 5 points, which we ended up hitting in this move up right here. Once we ended up hitting that 5 points, the stop was moved to break even, and then the second target we had was at the gray target line on the opposite side. Now today with the Russell, that second target I think is a very good demonstration of why a trailing stop in an example like today is a much better alternative compared to what I do, which is to have a break-even stop here, the second target at the gray target line, and see which one gets hit first. If you had a trailing stop here, you were able to protect a greater percentage of this move up in the Russell because we did not end up hitting the second target there prior to coming back down and retesting the cyan line into the close here. And so this entire gain in the second contract was wiped out of right around 14 or so points on the Russell, which I think was a fairly sizable gain in just looking and sticking to the plan of trying to see if we made a move to the gray target line. So this is that trade-off opportunity. In the past, I've shown examples in which having a trailing stop kept you out of a fairly nice winner to the gray target line. Today, I think, is a good example of the reverse in which not having a trailing stop here and missing the target off for really just a few points kept you out of a fairly nice winner in the Russell. So keep in mind, this happens either way. So the trick here is to just pick one. Either you're going to go with the trailing stop on the second target, or you're going to go with the OCO order, looking to see if we hit the gray target line or our break-even stop first, and then let the trade really just manage itself. Just do it in a consistent process. Now we'll switch gears to the S&P here. The S&P, we come into the scalper. And now let's take a look at the S&P and the Dow where we did not see trade opportunities that set up. So in the S&P, very similar. We had the scalper doing a good job of containing price action in that first hour. And then in the second hour here on the S&P, we saw a breach, very similar to as we've seen on the Nasdaq and the Russell futures, where we breached our volatility box sign entry line. We're looking for a bullish edge signal confirmation. That does not come prior to going outside of the clouds. So again, we know to rule out the scalper. That then takes us to the aggressive volatility box models. And with the aggressive model, that did a much better job of containing price action where we breached our sign entry line. We then saw an edge signal confirmation. We were looking for an opportunity to enter the blue cyan line, which we never got prior to going and hitting our first target. And so that trade already hit the target prior to us being able to even enter it. So the S&P, we never got an opportunity to get a fill there, but the trade setup in itself was valid. We just never got a chance to enter at the prices we wanted. And then if we take a look at the Dow should be something similar as well. So if we start off with the scalper, I thought the Dow was a little interesting where by that 7:30 email that I sent out to our futures members, we had already eliminated the scalper as a result of us breaching the cyan entry lines in that first hour test. And we didn't see a follow through in the opposite direction of what we were looking for prior to going outside of our clouds right here. Once that happened, we knew right off the bat to not be looking at the scalper regardless. And so this is the first sign that you knew that the Dow was a little bit more volatile compared to the S&P, the Nasdaq, and the Russell. But now with that break, we then came over to our aggressive volatility box, which did a much better job of containing price action, but did not give us any breaches like we had in the Nasdaq, like we had in the Russell, and technically like we had in the S&P as well, where we just didn't get a fill. All right, so I hope this walkthrough helps to give you an idea of what a nice winner looks like, something like, say, the NASDAQ futures, what a winner in which we didn't hit the second target looks like, something like the Russell, which also helps to paint this idea of the trade-off between trailing stops and OCO orders, and then finally, what no setup also looks like in the case of the S&P and the Dow, two of which were slightly different reasons why we didn't get the setup. In the S&P, we breached, but we never got an opportunity to enter at the price we were looking at, and in the Dow, we never breached at all, so no setup, period. All right, hope this walkthrough helps. Take care, everyone. Good luck trading, and we'll see you in the next update.